We're joined today by Steve Promnitz, who is the CEO of Lake Resources. If you don't know Lake Resources, they've had an extraordinary month with the stock up 100% in the month of March. Now, Steve, congratulations on securing a non-binding memorandum of understanding with Hanwa, a Japanese trading house, and that's for between 15 and 25,000 tonnes of lithium carbonate and lithium hydroxide. Now, in yesterday's ASX release, you talked about a strategic collaboration with Hanwa and other downstream participants within the EV ecosystem. Can you tell us who Hanwa is, and can you talk to what that collaboration might look like and how it might work?
Thank you very much. Hanwa are very well known in the industry and have been for decades. They work with cathodes, precursor material for cathodes, sourcing the raw materials, and they're part of that very traditional supply chain. You might remember a project called Bacanora in Mexico. They were involved in that as well. And the whole idea of this agreement is that then they can work with the other battery makers and EV makers, predominantly Japanese. Unfortunately, we couldn't name them in this agreement yet, but that will come out with time. And they're all of a very high quality. But the key takeaway is that this is a long-term arrangement with a key player in Japan and in that whole battery supply chain. And through this, we can now start working on our next projects as well. And these are the sorts of agreements we've been looking for some time. We don't want to be just another raw materials producer. We actually want to be embedded in that supply chain at a size that's serious for the long term.
Steve, now has Hanwa already qualified Kachi carbonate? If so, do you expect this will facilitate offtake agreements between Hanwa and its downstream customers? And is securing further supply chain participants required by Hanwa before they can convert to a binding contract?
So first of all, we have sent out small samples of our product, but for somebody to actually qualify the product, we need to get much larger volumes to be utilized. So that's a long-term project. That takes a minimum of 6 months, up to 12 months to do so. So you really got to have work out who you're going to be working with before going down a natural condition subsequent, but we're quite comfortable to be able to meet those. Naturally, the way agreements work in Japan and South Korea is that you will normally have a non-binding MoU, and this shows to all the parties involved that they're serious and you're moving down towards a more important announcement. Sometimes they aren't actually announced to the market, and this is just to ensure that everybody knows that this is actually a serious conversation. And we'll come out with those with a binding agreement when that's completed. But I do warn investors that it is non-binding, but the difference is when you're signing those in Japan or South Korea, they tend to be quite significant.
Can you detail any additional conditions precedent required by either party to move this from a MoU rather to a binding contract, and any particular reason you didn't push for a conditional binding MoU?
There's certain things I just really can't talk about. What is in the public domain is what I'm allowed to talk about. There's naturally a process now as we move to a conditional framework agreement and then a final agreement, and there's steps that need to occur. But I just can't really go through those at the moment. But to be honest, none of them are particularly surprising. Any of the other companies in the space have gone through it as well. It's just a matter of getting everybody involved. We're trying to sign tripartite, or there could even be 4 parties involved as part of the final agreements. On the side of the offtake, it's a little easier because everybody wants offtake, and they're particularly interested in getting offtake of a high quality product, particularly at volume. I would point out to your listeners that the size of this offtake is equivalent to most people's complete annual production that are currently listed on the ASX. So it's an important amount. What takes a little bit more time is getting an alignment between all the various parties around an investment in the company and who will be participating in that.
And now, Steve, you suggest that Hanwa is considering meaningful investment in Lake, and you say that Lake will continue to exist in the long term. Given robust M&A activity, are you suggesting Hanwa's equity investment could be sufficient enough to act as a blocking stake in the future?
No, that's certainly not the intention. The thing is, as many of your listeners would know, Lake actually has quite an open register, and that's both a good and a bad thing. So we have high liquidity, but we need to get some longer term supporting shareholders onto our register, not as a blocking state, just as to have a meaningful investment that works with us so that they have a shared outcome. The thing is, we saw last year, as you've alluded to, quite a bit of M&A activity. We saw projects essentially taken off the table. Most of the projects around us in Argentina were consumed by different entities out of China. And so what we're looking for is, as we move forward and try to get all of our final parts of our financing and feasibility studies and then offtake partners, that all of those various parties are also aligned at the same thing. That's all. And as I said, we do have an open register, so we would welcome that sort of meaningful investment, and probably not just from them, but the other participants that we're talking to as part of that supply chain.
You state that market prices are expected for any finalised Hanwa offtake. Are you suggesting there will be a high correlation between prices received and spot prices in China?
In the past, offtake agreements were mainly set with a flat price going forward, or maybe there was some adjustment mechanism. And you've heard me speak previously that we have been looking for very much a market-based mechanism where you look at benchmark pricing, such as fast markets, benchmark, S&P Global Platts, together with looking at spot and also some of the contracts in place. And you essentially average those on the previous quarter, looking into the next quarter. So that's the sort of thing that occurs. And even people who currently have contracts, we have heard conversations that they're changing those to this process. But we've seen these in other commodities. I think that's what's going to happen in lithium. It's just it's a slow transition, and we've been pushing for that. And I can see that there's some other companies who are successfully reaching the same sort of approach.
Steve, you suggested that prior, Lake is prepared to share both the gain and pain of kind of price volatility with some tier one offtake partners in the future. Now, in the oil industry, we have this kind of cap and collar pricing mechanism, and it's often used by large creditworthy customers to kind of share the risk and reward scenario. As this mechanism is nowhere to be seen here, does this suggest you remain in discussions with tier one battery or EV makers?
First of all, the cap and collar system really hasn't been used here in lithium supply. What's been used has been more just a flat pricing mechanism, and sometimes with some adjustment approach. What we're doing, as I mentioned before, is we look at the price providers that are currently around, for example, fast markets, benchmark, S&P Global Platts, together with spot pricing and some of the contracts, and it'll be a blend of those. It'll be backward looking each quarter. That's what I had hoped to transmit in the announcement. And look, pricing is up at the moment. I don't know what long-term pricing will be, but it ain't coming back anywhere near $15,000 a ton anywhere this decade. So yeah, there'll be some sharing on the downside in the future, but essentially by doing this, we ensure that we work with our longer-term partners, and as pricing goes up, we share in that. As pricing goes down, we share in that. But your listeners need to be aware that the reason we're able to do these sorts of contracts is because there just isn't enough new supply coming. And even if the projects that we can see came on board, we're still well short. So it's going to be in our favor for quite some time. To be honest, you only need a couple of years at this sort of pricing and the whole thing is paid for itself.
Now, Steve, you already have two export credit agencies inside the tent, so to speak, And now you have a non-binding memorandum of understanding with Japan's Hanwa, who are A- credit rated company. Now, analysts see your credit risk declining, and thus your chances of receiving low-cost funds continue to rise. Can you talk to how broader project funding for the Kachi project is progressing?
So as we've previously described, we've got strong indications of support, and we'll be able to comment on that soon more strongly, but strong indications of support that the export credit agencies and their banks will provide 70% of the total project funding. Then on top of that, we've got 100 million Aussie at bank at the moment. We'll have another 60 come June through options conversion. Lilac will, depending on their equity involvement, will be putting in 50 to 70 million US. And so then we end up with a shortfall of 50, 70, 80 million. You could reasonably expect most of that to be coming probably from the offtake partners. So we're well financed. We'll probably need to top that up just to ensure that there's enough to pre-order equipment as early as possible. But I think we're very well positioned for this first project. A key takeaway from this agreement is that we're now looking at how we get the next project underway. And we've been successful in getting our team built out on site. Now we're looking at establishing new teams for the next project. So look, it's an exciting time.
Steve Promnitz, thanks for your time.
Super. Cheers for now.